Hello, my name is Benjamin Hewlett and welcome to our channel, Death and Taxes. To quote Benjamin Franklin, the only thing certain in life is death and taxes. So today I'm going to talk about making tax-free money. Now, a lot of people talk about tax-free money when it comes to retiring, because one of the huge benefits of having tax-free money is making it so that Social Security doesn't become taxable. Now, we're not going to go into this very heavily, but basically what happens is that if you make additional money beyond your Social Security, you can actually make Social Security taxable. And so by having tax-free money, such as Roth IRAs or other types of tax-free money, it actually makes it so that your Social Security isn't taxable. So it's a huge benefit to, number one, have Roth IRAs. So if you looked at a Roth IRA after tax, let's say that is $3,000, and you looked at the exact scenario of a traditional IRA, and let's say that is maybe $4,000 because it's pre-tax. So if you were to put it at after tax, it would be $3,000. So those two scenarios are exactly the same, and you put them in exactly the same accounts, and they grew. The traditional growing basically on a deferred tax basis because you're going to be taxed on it when you pull it out. And the Roth IRA growing tax-free. When you pull it out, you don't have any tax. Those accounts would actually be exactly the same. Now that's because a Roth IRA, you're only putting in $3,000 because it's after tax. And the traditional, you're putting in at $4,000 because you are putting it in before tax. Those scenarios would actually look exactly the same if you're taxed at exactly the same tax rates. So they do grow exactly the same. However, again, like I said, Roth IRA, you can put $5,500 in. Traditional, you can put $5,500 in. So you're getting more bang for your buck with the IRA, with the Roth IRA. So one of the best ways to have tax-free money in retirement. In fact, I talked to one of my mentors I talked to one time, who makes a grundle of money, told me that in just putting in to IRAs throughout his life, he maxed it out every year, which has changed throughout the year, but let's just say it's between $4,000 and $6,000 every year. He is actually able to accumulate over $800,000 just in that account. Pretty amazing, pretty amazing. Now he has lots of other investments, and that really is besides the point, but the point is that he is very convinced that that is one of the best ways to actually grow his portfolio was just through putting in this $5,000 or whatever the year's maximum amount is every single year. So again, Roth IRAs, zero tax when you pull it out because it's put in after tax dollars. So the next way that you can make 0% is actually through capital gains. Now, capital gains are taxed at 0% up through the current 12% tax bracket. Now that's about $40,000 if you're single, and it's about $80,000 if you are married filing joint. Now look at your specific tax bracket for your year if you're curious what the exact amount is, but that is the taxable amount. So if you took the standard deduction in 2018 at $24,000, then you could make a total of $104,000. And if you pulled that down to, or you took off that standard deduction of $24,000, that would pull you down to about $80,000 taxable. If you made no other money and you had an $80,000 long-term capital gain, tax-free, zero tax, absolutely no tax if you got an $80,000 long-term capital gain. That is amazing. So truly amazing. If you plan right, you can get that long-term capital gain at 0%. So the next way that you can get 0% is through Treasury bills and through municipal bonds. Now, you have to be a little bit careful here because Treasury bills are actually taxed at the federal level, but not at the state level, and vice versa. So if you have a state bond or a municipal bond, then you're taxed zero. You're not taxed at the federal level, but you are taxed typically at the state level. So we want to make sure that you look at that for your particular situation, because if you were to live in a state that had zero tax or zero income tax, for instance, Texas has no income tax currently, then you don't have to ever pay any income tax. And therefore, if you had a municipal bond, then you wouldn't pay any income tax on the municipal bond on the federal level. And again, obviously you wouldn't pay it on the state level either. So a great way to have 0%. So the next way that you can get a 0% tax rate is through what's called qualified small business stock. Now this gets a little bit complicated and may be for people that have a little bit more money, because what you can do is you can put money into a C corporation. If it's what they call first seed money or the original investment of the C corporation, and you hold that for 5 years, then when you sell that stock, it's taxed at 0% because it's called a qualified small business stock. And that potentially could be rare, but if you structured a situation for you personally, let's say you started a C corporation, let's say it's a technology company, and you owned, let's say, half the stock, and you sold it for $1 million. You own half that stock, you have $500,000. That's taxed again at 0%, believe it or not. So those rules are a little bit complicated. You want to make sure that you looked at that more in depth with a tax professional. But again, another way that you could pay 0% on your taxes. Another way to receive 0% tax money or money that's tax-free is through life insurance. So if you have a life insurance policy, let's say that I had a life insurance policy on a parent and that parent dies, all of that money comes to me tax-free. So another great way to have tax-free money. Gifts are also not taxable typically. It's never taxable to the person who receives the gift. It potentially could be taxed to the person giving it. However, that is pretty rare. So I'll go into that in a little bit more detail in a different video. But basically what happens is that if you receive money from a person that is giving a gift, and it's less than $15,000 currently in 2018, you don't have to do anything. If it's more than $15,000, you just have to fill out an additional form. It's Form 709. And it's still not taxable because you have this lifetime exclusion of $11 million. It's actually a little bit more than that. But you have this total lifetime that you can give up to $11 million. And then after that amount, it does become taxable. But basically, for the average person, you're never going to pay tax on that gift. So if you get a gift from your parent or from someone else, it's not taxable to you. It's typically not taxable to them unless, again, they're above that amount. So inheritance also typically is not taxable. However, it follows the same rules. So gift and inheritance or estate tax is under that same exclusion amount, which currently is about $11 million. So all great money to have, that all have 0% tax-free money, a great way to make Social Security non-taxable. So again, if you have any other questions, please leave it in the comments below. Give us a like, subscribe. Thank you for watching Death and Taxes. This video has been brought to you by ClickTax Pro. If you want a tax professional like myself to prepare your taxes at a fraction of the cost and time, download ClickTax Pro. See the link in the description below.